There are a lot of ways that multifamily has changed over the years. Back in the day when I first joined, we were seeking funds for each specific real estate deal that we were doing. So each deal had to be created with a whole lookbook on what it was that the bank or the life insurance company was contributing dollars towards. Nowadays, lots of real estate is done through funds. And so there are great pools of capital that are gathered together that then can be used to acquire or newly build apartment communities. Again, my space has only been multifamily over the years. So the source of funding has changed, which makes it easier. My experience has been in the public arena, working for a large real estate investment trust. In fact, when I was with Trammell Crow Residential, we decided to go public, went public in the fall of 1993, had a successful IPO as Avalon Properties, merged with Bay Communities out of the West Coast and created Avalon Bay Communities. And then I also spent a number of years with a private family-owned company, large, 60,000 apartment communities nationwide. But different ways that those debt structures are put together, different way funding comes in the door, both attracting capital in different ways than they have in the past. And that's the most significant change during my career. Furthermore, you've got things like disruptive technology, what's happening in the space where our residents live. It's very different than what it used to be. I think my most successful, proudest moment probably is with the IPO, the initial public offering of Avalon Properties. We were 7,000 units. This was over 25 years ago. In fact, we had a 25-year celebration in New York City in November of 2018 to recognize that significant event. Avalon Bay is huge now. It is the gold standard for the multifamily REIT. And my colleagues who are still there running the show are doing incredible things. But that was really exciting to go from privately held to a public entity traded on the New York Stock Exchange. My responsibilities at Avalon Bay Community changed over the years, but primarily the country was divided into two, and my colleague oversaw the West Coast and I oversaw the East Coast operations. And essentially what that meant was, how do we provide the best results, financial results, to our investors, while simultaneously, and perhaps even more importantly, providing a great home for our residents. So of the number of apartments that we had under management, I was responsible for the day-to-day operations. That would include things like the leasing of apartments, the maintenancing of those apartments, the marketing of those apartments, and putting together the different teams that helped run these operations in the different locations where we had our assets. So property operations is all about the fundamental day-to-day operations of a particular asset. The way typically it is structured is there are different roles and responsibilities at the property level to ensure that the property is well maintained, that the property is safe. My responsibility was to mitigate risk and to ensure that we were providing an environment where our residents felt comfortable and happy to call this place home. Because after all, what happens in an apartment community has to do with everyday living that occurs in anyone's life. The people move into apartment communities for a number of different reasons. They've gotten married, they've gotten divorced, they've graduated from college, they now have a child, they need to move into a bigger space. And oftentimes in the markets where I operated with the quality of asset that we owned, these were renters by choice, meaning that they didn't want to necessarily have the home ownership responsibilities of shoveling snow, dealing with a landscaper, those kinds of things. But they wanted the flexibility of a shorter lease term, 1 year, 2 year, the ability to move with their job, their ability to transition more quickly than they might otherwise, good school districts. But the day-to-day operations resulted in the bottom line financial performance, which was then represented through our stock price when I was with a public company, or through the returns to our investors when I was with a large national privately held company. And my responsibility ultimately was to ensure that we could achieve the financial results that we represented when we first invited the investor into the deal. Part of my responsibility centered on the investment thesis. Why did we make a decision to acquire one asset over another asset? And different companies have different reasons, strategic rationales for why they make the decisions that they do. There are all kinds of factors. Do you want to be a national company? Will you be in any city? What kind of asset are you interested in? Multifamily, storage, commercial, retail? My experience has only been in the multifamily space. But what are your expectations and what creates that investment thesis? So typically I worked in one of four areas. One would be management opportunity upside, so a management play. What did that mean? That meant that we had enough other assets in the market that we could improve the day-to-day management opportunities at a particular asset, whether it's through greater efficiencies, economies of scale. We already knew the local landscaper. Now they could come and take care of this particular community, or other things that might influence the bottom line performance. Another example of a management opportunity might be that the current owner lives and is headquartered far away in a different state and only has one or two assets. And because they're so remote, they don't have on-the-ground presence to really oversee the property. And we all know the old adage, real estate is all about location, location, location. So one of the strategies for us would be the management upside opportunity. Another strategy to help us decide where to acquire an asset would be the transitioning neighborhood or the emerging market. So we always particularly liked in core markets, which are typically gateway communities, metropolitan cities, and particularly around the city center, the areas that had very robust retail, commercial, and residential housing buildings already in place. And so the emerging neighborhood might be a mile away or so, but the data would suggest that the market is going to continue to creep further out to where that asset is. And so you're buying, assuming that that asset is going to see an increase in revenue, in rent, because it's going to be more in a premium location over time. So that would be the second strategy. Another strategy might be value add. What is the renovation opportunity for that building to make it more relevant? So there are a number of examples in many cities where older buildings have been renovated and can stand up against the brand new communities and in fact offer charm and other advantages, and that makes it more appealing to people. It has been interesting in recent years that the influx of capital, particularly foreign capital, has been all about the value add opportunity, such that companies are recognizing that buying new buildings is cheaper. That's a cheaper way to do it than the value add. And of course, value add has more risk associated with it. You have to rely on your contractors, you have to rely on the products being available, or you have to have the staff in-house to be able to do the renovations. But that was the third approach we looked at. The final approach that we would consider would be what I call pricing dislocation. What I mean by that is an asset that has challenges with it. There's something funky about it. An example might be it's 300 apartment homes, started out as a condo community. 50 of those units were sold as individual condos to owners. And then the deal fell apart and it became an apartment community instead. So you have 250 apartments and 50 single owners. Imagine how complex that is, yet someone is trying to now sell all 300 apartments to you. So you have to then figure out, what is my opportunity to buy those 50 owners out of their deeds, out of their homes, so that I can have a true apartment community? Those are much more challenging and risky, but at times make the right choice. So those would be the four strategies. There are many other strategies that different companies pursue, but those are the areas where I am more experienced in terms of making the investment decision. Having served on the investment committee, we look at a number of different factors. One of those four strategic efforts would be what we would anticipate and decide, yeah, we want to buy this deal. The evaluation process for determining to acquire an asset or not is pretty detailed, as you can imagine, because it's going to be a really big investment, $50 to $100 million investment to buy a particular asset. And so there is not only a very thorough due diligence checklist that my teams and I would follow, but also lots of hands-on coordination with local vendors, engineers to walk the property to ensure the roofs were in good condition, that the topography and the slopes looked great so that if there was rainfall, etc., there wouldn't be flooding or other opportunities. Or if there was, which would reduce the price, we would know how we could go about and fix that and increase the value overall of the asset. But it required lots of on-site examination of what was happening, walking a certain percentage of the occupied units. And you can imagine that requires a lot of forewarning through notification to the existing residents. Hey, people are going to be walking through your unit, always accompanied with somebody on staff, right, to protect the interests of those residents, but walking through the units to take a look. And you look for telltale signs, leaks, mold, those kinds of things. And there's all kinds of equipment that you can use nowadays too to tell if, there's urine stain from pets or if there is mold growing, etc. And then you could also get a good sense of what is the value add opportunity, even if that wasn't your expectation up front. I want to switch out the metal closet doors because that screams 1980, and I want this to be relevant to 2020. In addition, you would do a long, hard look at what the financial statements demonstrated. If you see a decline in expenditures, that may be an indication that the seller is trying to boost the value. They're trying to grow their net operating income so that divided by the cap rate, you can figure out what the sales price is of the community. But if there is an artificial decline in expenses that you can't underwrite, that doesn't make sense, that's an indication that they're holding off on expenses, and there should be some further examination done to see what's really happening at this community. Have they really been taking care of the grounds the way they should? Or are they not putting mulch down in the backs of the buildings because no one sees that as much and it doesn't make the first impression? I want to have a community that does, in fact, have mulch everywhere, so I need to anticipate what the cost is. And imagine, if I add $10,000 of cost to operating expenses and you're at a 5% cap rate right now, I've just reduced the value by $200,000. Likewise, if I can gain efficiencies by sharing costs with other communities in the neighborhood or bulk purchasing different contracts with vendors, etc., I can drive down legitimately my operating expenses, call it $10,000 again, 5% cap rate again. I've just increased the value of that asset by $200,000. To me, that's why property operations, the people on the site, are so critical to the success of the asset. And we often talk about, in this wonderful world of commercial real estate, the significance of the developer and how great he or she is with this build it, they will come mentality, and with the investors who provide the dollars, whether through equity or through debt. And I would contend, having spent many years in property operations, that it's the on-site teams that also deserve good recognition for what it is that they do to increase the value of the asset and to ensure that the home where the resident lives is indeed a wonderful home where their memories are being made. In determining the price to be paid for an asset, there is always negotiation. So our engineers are going to come out and determine that the lifespan remaining on the roof is X number of months or years, and the seller is going to assume, no, the roof is going to last longer. So there are always the negotiations that happen, not only to the capital improvements that are needed to the community, but also regarding the strength of the revenue stream. So there are leases in place. It's important to assess the strength of those leases. It's important to understand the bad debt or the credit loss, whatever terms you want to use, which means that people are not paying their rent. Why aren't they paying their rent? What's the seller telling you about the reason for that? Is it because of a one-time event that occurred and people stopped paying their rent? Is it a more concessionary market? Have they been having to offer more concessions or discounts to the rent? What's the viability of what is happening in the marketplace? What's your loss to lease? Which in essence is the difference between if all the apartments were vacant right now and market rate is what it is, you could get X amount of dollars. Well, that scenario never exists. You don't want all the apartments to be vacant. So there is 95% of the apartments vacant, 5% can be marked at the market rate. And as those leases turn, what is the expiration date? Are they in the winter months when you don't have much traffic coming in the door? That's a problem. Or are they in the peak leasing season, in which case you can likely take advantage of increases to the rent and approximate market value a little bit more quickly. So there's all kinds of analysis that's done to help determine where you come in for your price point. And then the negotiations ensue from there. How quickly can you close? Are you dependent upon getting debt? What are the other terms and conditions? There are other factors that we look at as well. What if the apartment homes, a percentage of them are set aside for students? We often know that students are more cyclical. They tend to leave during the summer months and they'll break their lease. They're happy to pay the cancellation fee to break their lease, but that puts the exposure back on me as the manager or owner of the asset. We could have corporate apartment homes. Those are apartments that are fully furnished and set up for corporations to come in, often on short-term leases. So those lease terms, while they are paying more for the apartment, are less secure over the long run and may, in fact, if a corporation stops their contracted work and pulls out 30 apartments on 300, 10% of your units now vacant. That can create some stress points. So those are the different factors that one looks at when negotiating with the seller to determine what the appropriate purchase price ought to be for the deal. The million-dollar question is, how do you determine where the next opportunity is within real estate or, in fact, any business? And I think there are a number of different things that may come into play, but I clearly don't have the answer because if it were that easy, there'd be many, many, many more millionaires. But I think it's a number of different things. I think it is deep, inherent local knowledge. So people who have been in a market for a long time start to recognize the trends. They see that first, I think it's things like tattoo parlors and bars and edgy things start to emerge, and that's an indication that that may be a transitioning neighborhood. There's certainly data that's available now, much more available now than it was when I first started out in my career, where we were using maps and putting little stars on the map to show where the competitors were. Now you can use wonderful companies out there that provide that data in real time. So it's looking at trends. It's always understanding household formation, job growth. It's those macroeconomic trends that one needs to look at, discern, and then apply it locally to what's happening in the market. And a lot of it is, who else do you know in the community? It can be local business owners. They can be people who have been in the school systems for a long time. It doesn't matter. What are they saying about the different markets? So real estate success to me depends a lot on truly understanding what's happening in market and being in touch. And again, that gets back to real estate is all about location, location, location. And to be successful, you need boots on the ground. You need to be in the different markets. I don't think it's a successful strategy to sit here in Washington, D.C., without any eyes on the ground out in Seattle and decide that I want to invest out in Seattle. I need somebody out on the West Coast knowing that market before I can make that kind of decision. So when I think about how to value an asset, I think there are a number of different ways to look at all the different metrics that are out there. And I'll quickly say that I think in the world of real estate, we like to use words that get confusing. I don't know why we don't simplify the language. We talk about equity, which really means money, and we talk about debt, which usually means a mortgage. And we like to talk about different terms that to me should just be simplified. But in essence, part of the investment thesis or the idea to value a property is based on a number of assumptions that one makes. What is your hold period? Because that factors in to the cash flow analysis that you might do. What is the cap rate? The cap rate is simply the yield on the deal. So if you take your net operating income for the year and you divide that by the purchase price, you'll figure out what the cap rate is. As cap rates compress, as they get smaller, the value of the community goes up. And it has been interesting in the multifamily space to see the compression of cap rate values over the last several years. And what that means is there's more available dollars to buy the real estate than there used to be. In fact, we're seeing a reverse solicitation, which means that foreign capital is coming into the United States at a pace that it didn't do in the past. So whether it's the sovereign nations, European countries, they're getting greater returns in the United States than they are elsewhere. And so there's more capital coming in, which means that there's more demand for limited supply. And that is a trigger on what happens with cap rates. If you have the net operating income stream and the cap rate and the purchase price, you've got all three. You only need two to figure out the missing third. And so cap rate is simply a yield on the asset. It's a ratio between the net operating income and the cost to acquire the asset. To me, the foreign capital coming into the United States has not been evidenced as strongly in the past. Why is it happening now and in the last number of years? Look at the returns that are happening in other countries. Look at the bond rates. They're negative. That's not a place to invest when that's happening. And so you look at what's happening in the United States, and we continue to see strong job growth. We have low unemployment. So again, these macroeconomic attributes, demographics, all of those different things that we look at would suggest to outside countries, investors, that the United States is a place to be. We are seeing unprecedented job growth, particularly in certain markets. Certain cities are doing very well, and so the capital is coming in. People want the investment opportunity here because the returns on their investment are a lot better than what they would get in their own countries. On a core market, so that is the most secure kind of market, gateway cities, city center, access to everything, you can expect a return probably in the 6 to 8, 6 to 9%. That's pretty decent relative to other locations. Core plus, which would be other metropolitan cities, but not the gateway cities, could include suburbs, still has a robust tenancy or residency list, the lease is in place. You still have Starbucks in the neighborhood, but it's not city center. Core plus markets are probably returning 7 to 11%, somewhere in there. Renovations, riskier. So you would expect if you're going to put your money in there that you're going to get a better return over time. That's probably more, 9, 10, 11, 12% return. The fourth investment class, which I don't have any experience in, is opportunistic, which is much riskier. And clearly there, the returns should be expected to be higher. I'm not familiar with what foreign capital is coming into those particular markets, but I can say that the foreign capital has been very interested, particularly in value add, so the renovation opportunity, such that newer product is now priced in a number of markets at a lower rate than what the renovation is. Now, that's because the renovation has a higher upside, but boy, it's a little bit more risky. So that's been an interesting phenomenon in recent years. Oftentimes people move to apartment communities for wonderful events that occur in their lives, a marriage, the birth of a child, and their memories are made in those four walls, in that apartment home. It's their home, and what happens in their home is their life. It's what happens to them. And so whatever I can do in my career to help make that better. Another example of making it feel like a home is a washer and dryer. Back in the day, additional income used to be achieved by going off to the laundry room and having worked out a contract with the laundry provider. And people would have their quarters and they'd go do their laundry. Increasingly, through the renovations and certainly with new apartment communities over the last several decades, washer and dryers are part of the residence. And that's because that makes it feel like home. Nothing screams apartment, it's not part of me, I'm different, I'm not worthy, than having to lug your laundry basket across the courtyard over to the laundry room to take care of an everyday function that we all need to be doing.